Welcome back to Talking Point. Focus now on Indian hotels. Their numbers are out for Q4 and looks good, in line on the face of it. Slightly lower than Bloomberg's estimates, but revenues up 17% to 1,905 crores. EBITDA up 23%. Margins have grown at 167 basis points, and net profit looks quite healthy at 29%. Puneet Chhatwal, Managing Director and CEO of IHCL, is with us now on the show. Mr. Chhatwal, thank you for speaking with us here at NDTV Profit. Let me understand what has worked this quarter and what perhaps has not, because ARRs have grown well at 4%, but slightly below the levels that we've been seeing so far.
Not really. Ours is, firstly, thank you for having me and good morning. Ours is a bit of a seasonal business. So Q3 is always the best quarter and will remain in the foreseeable future. Q4 is the second best quarter. And as the base keeps increasing, the percentage rise will start declining, because just imagine coming out of COVID, where we had almost nothing. We started showing growth in like triple digits, and then it went to high double digits. And at some point of time, it has to come back to single digit. Important is to look at the CAGR of last 5-6 years. And if we looked at that, then we are showing and demonstrating, both as a sector as well as our company, a very high and a very healthy growth.
What is the sort of outlook you see, or a sustainable growth trajectory for ARRs? I know that there's no guidance that has come in for Q1 FY25. I'm wondering why, and overall what the outlook is. Any kind of perspective that you can provide?
We have kind of held back a guidance just on ARR. So we have given in our press release a guidance, and also to the investor community, of a double-digit growth in the top line for the next financial year. And that is very good, because as I said, the base is large. And why not just on ARR? Because only 50% of our total reported revenue comes from rooms business. We are still, enjoying very healthy growth on the food and beverage side, on the wedding business, with the Prime Minister's appeal of Wed in India, and spiritual tourism. So there is a lot of that kind of impact that is important in the top line growth. On top of that, we have very strong not like-for-like growth. So last financial year, we opened 20 hotels. This year, we have guided to open 25. And all these new hotels that come in, they start at a lower average rate or occupancy, because it just takes 2, 3, 4 years to ramp up any business. So giving a guidance on a high growth company on just ARR or occupancy is not, in our opinion, a very intelligent way of providing such inputs.
Okay, so ARR has been held off because you have a lot of new properties which need to ramp up. Understood. Let's just talk a bit about Capex. And when we spoke last quarter, Mr. Chhatwal, the focus was a lot on saving costs, cutting costs, operational costs, and that had worked. Is that leg going to continue in conjunction? Can you give us your outlook on the kind of Capex that you will see in the next financial year?
The channel is not that old, but it seems like a long time ago that I said on cost optimization. We all did that during COVID. So maybe that was a conversation you and I had. But on this channel, I would say that it's very good that all of us have learned to be more diligent with the costs. And that opportunity COVID gave us once in 100 years to relook at every cost. And it would be prudent to maintain that kind of cost base and take out the unnecessary costs that nobody wanted, neither the customers wanted nor other stakeholders wanted. Our focus has been definitely growing new businesses, which we have grown at 35% last financial. Going forward, we have given a CAGR of 30%, and keep also the growth at a very healthy level in our traditional business, especially our backbone with the Taj portfolio. And we are investing heavily in Capex Our guidance is around 3,500 crore in a 5-year period, of which 2 years have gone by with already more than 1,000 spent, another 2,500 to go, both in selective greenfield as well as upgradation of our iconic assets and building some of the competitive advantages on the digital front, on our private membership club like Chambers, etc. So all that guidance we've given, we are very much in line with it, and we will continue to pursue this aggressively unless another event happens that we are not aware of at this point of time.
Let's talk a bit about Ginger. A lot of focus there. It's been relaunched in a new avatar. It's an upscale offering. What is the focus and outlook for Ginger and the kind of contributions it will have to your revenues?
Well, Ginger, we are very proud of the launch of the Ginger Mumbai Airport, which is the flagship Ginger. That's number one. Number two, 75% of the Ginger portfolio now is in the lean luxury category. Number three, that lean luxury category is driving a margin north of 50%, to be precise, 53% in last fiscal, but we expect this to grow further. And our growth in Ginger brand will be going forward at least 10 hotels a year, and we are very pleased with that. Also, we have changed the model for Ginger. It's not really a capital light model, but it could come under capital light because operating leases do not require any capital investment from us on an upfront basis. So we think the operating leases that we have started with Ginger will give us the required absolute return, but also on the margin side, much more than a typical management contract of 6 to 7% or 6 to 8% of the top line that is customary in the hospitality sector. So if you're doing 50% plus margin and you gave 25 or even 30 to the owner as a revenue share, you still have 20 or 23% versus a traditional management contract that would give you a maximum of 8%.
And what will be the mix in terms of owned and leased for Ginger?
We would invest in Ginger in order to monetize some of our land banks that we have. And Ginger Santa Cruz or Mumbai Airport is a good example. We had that land for almost 30 years doing nothing. And once we got the permission, we went ahead and built the flagship. And, these kind of assets, if your land is already there, it helps you in doing two things at the same time. One is demonstrating effective asset management and utilizing your assets which are not at all utilized. It's not a question of underutilized, but it was not utilized at all. So that's one, and land in India is very expensive. And the second is deploying your capital in building which is going to give you exponential returns, so which has a very positive impact on both your return on equity as well as return on capital employed.
Just to take that to the 25 new hotels that are in the pipeline for this year, Mr. Chhatwal, what is the mix there? Are these asset light largely, or any kind of demarcation that you can share with us?
So 25 that will open this year, most of them, I would say almost all of them we started using the terminology capital light, with the exception of Cochin International Airport as a Taj. That is a long-term lease with the airport, and we are doing the building and the improvements on it, but that's a limited investment. The other is really, one or the other selective operating lease in Ginger. The rest is all driven by management contract business.
Okay. Give us a sense of what's happening with the international business that was in a blip. Is that improving as economies seem to be turning, at least in the US, Europe, etc.? What is the sense you have over there?
Actually, that's a very good question. Europe we are very pleased with. Dubai has done well. There are two areas of opportunity which, if they start doing well again, then that will really present a hidden upside for us. One is Maldives has seen a blip because of all the news that we have read, and our business in Maldives was a majority share was coming out of India. So there is a short-term decline in Maldives, and US has not yet come back to the pre-COVID levels, especially San Francisco as a city. Has seen a very bad phase in the last 2-3 years, but we expect that to go back to normal post-elections, and that's our hidden upside, as well as we are making some, changes in New York, which should help us to recover also in New York.
Tell me a bit more about Maldives, Mr. Chhatwal. How much of a blip there have you seen since, of course, Indian tourists have been avoiding going since all of the geopolitical sort of crisis and feathers being ruffled there? What is the impact that you've seen?
Yeah, we have seen in the last quarter, I would say the last 4 to 5 months, a drop of 15%. I would say partially it is because of the news you heard, partially also Maldives was the favorite destination during and a little bit post-COVID for everyone. So I think the general traffic has not declined just because of the negative news that you have read, but it's a very normal thing. Everybody went to destinations like Maldives, like Goa, like mountain sector, or which was a bit away, a bit more exclusive. And that's what Maldives offers with all the villas that it has, that you have your kind of privacy and you are on a small island away from everyone. So I think a part is a normal adjustment and a part is a decline, but at some point this should go back to what it used to be.
Okay. Just one last point, Mr. Chhatwal, and I was reading a clutch of investor notes, brokerage notes this morning, and one thing that they say, of course, a lot on the upside because of the way economy is running, domestic tourism, etc., etc. One risk that they see, and I wanted your take on this, is that you're already at a high base. Do you see a possibility of growth moderation coming in at this high base?
There is a lot of things that will happen in the market, and all the notes written are based on possibly historical evidence. And I think my take together with our team in the management is that India is changing. India's fifth largest economy. Next year it'll be fourth. Very soon it'll be third largest. When you get to that level, when you have increase in per capita income, when you have a change in customer behavior, driving to destinations which we call, staycations or leisure trips, a lot of that has changed. Number two is the investment of the government in the infrastructure. That's a permanent change and a permanent base for new demand coming in. When the number of airports doubles, when the number of aircrafts coming into India is more than 1,200 over the next few years, when the number of high-speed trains, Vande Bharat or bullet trains comes, when the number of four-lane highways increases by another 100,000 kilometers, I think the fact that the base for India is changing, and it is already a very different country. The way it is recognized in the world and the businesses wanting to come here is a different country. And look at the impact it would have in 2-3 years from now. Right? We keep looking at the traditional metrics of the average rate or occupancy, and in isolation to what is happening around us, then obviously the notes will end up saying what they are. But many, I think, believe in the India story, and that is somehow reflected in the performance. If you look at our quarterly results, we tend to forget that our quarterly profits have become higher than our best ever historical annual profits. If we look at our revenue on standalone pre-COVID, for the full financial year, the standalone revenue is higher than the consolidated revenue we reported till 18-19 FY. So I think a lot has changed. Our portfolio has doubled. We have signed so many agreements, and you said about the pipeline of 25. Our pipeline is actually 90 plus hotels. So we expect to open at least 100 more hotels in the next 3 to 4 years, and 70 2% of that is coming under a capital light model. And we feel very comfortable that our not like-for-like growth will help us to sail through and keep delivering on the promises and the guidance that we have given to the market.
All right, so a very positive outlook there. Thank you so much, Mr. Chhatwal, for speaking with us today. Always a pleasure to have you on NDTV Profit.